I'd like to just start this discussion off by introducing maybe or talking about some of the big parameters that are out there. I'm Robert Buckley. I'm from Cornwall Insight. We are an independent company who advise companies, government departments and others in the energy market on the whole value, on all the elements of the value chain. So where can you earn money, where can you lose money, and how do you need to do things the right way to earn that return. So I'll be talking a lot about the market, but also a fair bit about policy and regulation. And James, in your opening remarks, you suggested that technology was opening up new opportunities and giving things for us here to debate that maybe we wouldn't have had even 2 or 3 years ago. That is equally true of the policy and regulatory framework. And one of the things that we've really learnt over the last 5 or 6 years at looking at different aspects of the market is that where does someone's opportunity become someone else's policy loophole? Because the history of this sector is of significant investment in different pockets of the market, rapidly followed by changes to industry rules, which make the investments that have already been made somewhat more difficult. We've seen that in renewables. We've seen that in capacity and in flexibility, especially small-scale diesel generation. We've even seen it to an extent in storage. And now we're talking about the private wire behind the meter part of the market. And a lot of the value that exists there is not just from the energy market, but also from the way that the policy and regulated charges are set. So if I just go a little bit further and say, well, what specifically are we talking about here? Essentially what we're looking at is the top part of this slide, using maybe a turbine, maybe a battery, maybe a turbine and a battery behind the meter, so effectively invisible to the system manager, and flowing power to and from the consumer and to and from the grid in response to price signals. So if you get more money from the grid, you flow the power onto the grid. If you get more money from the consumer, you flow the power to the consumer. And maybe the consumer is involved as well, because the consumer's demand can vary too, alongside what comes from the generator or the battery. And so we've seen over time a number of initiatives to capture this flexibility. First, in the wider market, National Grid was very innovative with its fast frequency response service, stimulated a lot of investment in storage. And batteries, we've had the capacity market and the kind of current iteration of a 1-year demand-side response capacity contract, but we've also had changes to the assessment of the value of storage, the physical value of storage to the system, which has also cut back what batteries are perceived to bring to the public system. And the more that has happened, the less notionally reliable they've been perceived to be, the more people have started to look at this prosumer, behind-the-meter private wire model. So you're essentially looking for the customer as a secure demand to look at alongside the ability to flow the power onto the grid. And I'm just going to show some numbers. They may or may not be right. They probably won't be wrong. That just show what we're talking about here, really. So we've got a build-up here of a total delivered price for a reasonably large high-voltage network consumer across Great Britain. And what you can see is actually the majority of the cost is not the wholesale power price. 35, 40, maybe 50% of the total bill. We have got shares of the bill that are greater than that come from policy and networks. And here we get into the way that electricity is charged for. As a consumer, at the moment, you are charged for your net consumption, so what you take at the meter from the public system, not what you actually consume. That is your gross consumption. So net plus what you make on site equals your gross consumption. You're not taxed yet on your gross electricity consumption, and you may never be. And then we have the taxes, VAT and the supplier margin. So this is the broad parameter in which we're working. And if we look a little bit into the future, if I can make us go forward a bit more, what I've done here is we've taken out the non-supply and the non-wholesale elements of the bill to show our forecasts. It's a slightly different profile than the chart I've showed you before. It's a slightly smaller user. But the track is the same. You can see the rising track of policy and network costs on their current trajectory. So if you're looking at an investment that helps you save these costs because you're not using power from the public system, it looks like in future the economics are going to get better because this stack is increasing. And you can see all the different cost elements there, particularly the costs of policy, the capacity market, and the cost of the contract for difference feed-in tariffs for low carbon generation beginning to come through there. So again, these are money of the day, so there's inflation in these. But essentially, in 4 or 5 years' time, this looks like consumers, industrial consumers, will be paying £80 a megawatt hour for the costs of networks and policy. That's a good proportion, 80% effectively of what the current price, delivered price is. So this looks like it's going to be even more attractive to consider whether you invest in generation on your site. And this is where batteries and storage come in, because at the moment, a lot of the network and policy costs are skewed towards the peak. So what I've taken here is some, again, we're going back to an all-in delivered price. So you've got a wholesale element here, and then you've got the different charges. This is a winter day between November and February, and we've just amortized out the different charges as they fall due. And you can see that great big hump there consisting of 3 different charges: the transmission charge, triad charge, the red unit charge for distribution, and the capacity market charge. So actually, the value that arises on the current charging structures is skewed at a very small number of half hours in the year. I'm sure many of you in this room will be triad managing your own consumption to avoid this peak. So this kind of chart will be one with which you'll be familiar. So that's kind of where it looks like we might be. Then I think we need to kind of take a step back and think a little bit more holistically about the electricity system and the way that it manages socially the secure delivery of electricity to consumers of all types at all times. You might not think that as a consumer or an investor, but we've got politicians and regulators whose job it is to do that. The electricity system is changing very, very rapidly. We're going to a system that's going to see a lot more intermittency. There's a lot less security of supply in both gas and power than we have been used to. And we have had, to date, a set of pricing signals for networks that particularly drive generator and consumer behaviour at the evening peak time on the system. In fact, the fact that we're even having this conversation suggests that maybe those signals are working a little bit too well, that too many people think that there's something here for them to do. And I would certainly, I've emphasised the structure, the timing, the nature of the cash flows and potential opportunity. I think you need to be very mindful of how these things may change in the future. That chart there is from National Grid. It shows the 3 triad peak times that we had this winter. What it doesn't show actually is that the highest demand on the system was on the 1st of March, when it was really, really cold, and it was outside the triad charging window. And we saw peak demand 2 gigawatts higher than anything shown on that chart. That kind of says to National Grid and others that maybe the triad regime is driving behaviour that isn't exactly representative of the usage on the system. Ofgem certainly has raised this issue, and we've got it running what it calls its targeted charging review, a significant code review, where it is looking at the structure of both the peak distribution and transmission charges. There's the Charging Futures Forum, which is also looking across the structure of electricity network charges. Both of those are expected to put out some documents in the summer that summarise their thinking on where the future path for charges may be. We've had a history of short-term interventions in the capacity market to change the rules on what is eligible and to what extent it is eligible. But also, on the other side, we've got some DNOs particularly who have become very active in looking to acquire flexibility as part of their desire to manage the flows on their local power networks. So this is fragmenting, disaggregating. This broad story is true today. It may well change a bit in the future, and other elements may well be added to it. So it's a very dynamic and busy space. Obviously there's a lot of interest in it, which is great to see, and I'm really pleased to have had the opportunity to discuss. Thank you.